debt sources, it's impossible for you to, it's a bit like boiling the ocean. It's impossible for you to prioritize them all simultaneously. So find a system, find a way to identify the one that's giving you the most amount of stress and have a conversation with that institution or that individual as to how you intend to pay that off. And so rather than you completely ignoring the issue and hoping it will go away, which of course it will not, it's important that you demonstrate that you are facing the challenge and that you are taking steps towards it. And so even if it means an additional 1% contribution that you can make to that debt over a period of time, that you are committed to doing something about it. And again, there's a lot of confidence that I think comes from that, knowing that you are facing your issue rather than trying to run away from it.
Thank you so much for that, Davinia. For those of you who are just tuning in, you're listening to the FIM Festival 2023 live discussion here on ZIZ Radio and TV. And we're also live on Freedom FM, Von Radio and Win FM. On the panel with me this evening is Davinia Tomlinson, award-winning entrepreneur and author, and Mr. Trevor Blake, Managing Director. Thank you guys so much for joining us. The conversation is going so smooth. Davinia, go ahead.
So we're now my favorite topic, of course, because we're talking about retirement planning and pensions.
Okay.
And I think, as I said at the start of the conversation, there are some misconceptions when it comes to pension planning. It's a bit like will planning. I think people assume that, it's for old people. And if you Google, as an experiment for anyone listening or tuning in, as an experiment, if you put pensions or retirement saving into Google and then click on images and just see some of the images that come up, it's a category that is synonymous with the elderly. And of course, we are drawing down our pensions in later life as elderly people, but we need to put money aside for our pensions while we are in our peak earning years, in our 20s, 30s, and 40s. And so, when you look at this on a global basis, very few of us are saving enough for our retirement. And that can be quite a sobering thought. Again, it's a bit like the debt conversation in which you think, well, I can never get out of this debt, or, I'm never going to be able to retire, so why bother? I may as well, or maybe, I've heard some people who will go even more morbid than that and say, I might die before I can even get access to my pension, so why am I bothering to save? And I always say, but what happens if you live? I want you to live. And what happens if you live?
Right.
So we need to start thinking about our pension. So again, when you think about our budgeting and our 50, 30, 20, for example, or whatever the ratios look like for you, see whether you can siphon off. I always say start with 1% and then increase it to 2%. If you are already saving into your pension, that is wonderful. Then for you, the next step might look like understanding how much you might need to retire. And there are a number of calculators. I know that there are some brilliant tools that are offered by the financial institutions in the region that can enable you to identify how much you will have if based on your current projected contributions into your pension pot. So just understand how much you will need and then what you need to do in order to get there. The next thing I would say when it comes to planning for future you, investing in future you, is to think about protecting what you have. So I think, again, lots of us, when you're having conversations about wealth creation, wealth management, immediately our mindset goes to, well, that's for people that have already got lots of money. We talk about high net worth or net worth in general. Everybody has a net worth. But again, it's a term that is synonymous with high or ultra high. So you think of millionaires or billionaires and you think, well, net worth is not a conversation that's for me. And it's a similar principle when it comes to, your protections. Lots of us will have maybe private health insurance if you're able to have that, or life insurance. For those of us that don't have that, I think it's really important that we think about protecting what we have, and we think of ourselves as our biggest asset by far. I always say this, whether it comes to you protecting yourself from a life insurance perspective, but just in general, knowing that everything that we poured into ourselves over the course of our academic career, our working lives, we've acquired training, skills, knowledge that enables us to go forward out into the world, into future jobs and careers, and command a really good salary. So we are assets. We need to protect our assets, and we need to protect what we have, however big or small it is. If you think about, sometimes there are stories about lottery winners that will come up in the press, and it will say, you might win £1 million or $1 million overnight. But then, in a year's time, when they track, where are they now, these people that have won the lottery? Well, if you didn't know how to manage $1, then you're not going to know how to manage $1 million. So starting where you are and doing what you can is a really important principle when it comes to your financial resilience, I would say. And then the final part, in thinking about future you, is making a will. And, you know, we've talked about, you know, what happens if you die intestate. So intestate is basically dying without leaving a will in place. We make a number of assumptions. I know some of the assumptions that we make might be cultural. I know that some people think, you know, if I write a will, then I'm inviting people.
I can tell you.
You invite confusion into the family. We don't want to talk about it. We think it's morbid. Some of us that are particularly spiritual might think, well, I'm calling death upon myself if I write a will. And I would like us to think beyond that, you know, involve, if you are somebody that has elders in your family, try to identify a way to broach the subject with them without them thinking that you're trying to kill them. Just try and have a really open conversation about legacy planning, because it's really important. And the easiest way to do that is to just point to some of the many examples that we have of chaos that can ensue when family members pass away. You're already in the midst of deep grief and bereavement, and then in addition to that, there is you know, so much legal complexity in terms of unraveling their estate, and that's not what we want. So having those things in place is a really important step when it comes to your legacy, estate planning, and investing in future you as well. So, you know, again, you know, very simply here, when we're thinking about our pension life cycle, and what should you be thinking about, you know, on the chart, for those people that are listening in, you know, we've got a chart here that is pointing to your accumulation phase when it comes to your retirement saving. And your accumulation phase, exactly as it describes, is the point at which, or the period of time through which you're accumulating cash, whether it be through fixed income deposits, treasury bills, stock market investments, shares, whatever it is, that will contribute towards your upkeep in later life. Your decumulation phase, of course, is the drawdown. So this is basically the point at which you've now retired and you need to get access to your funds. We need to be thinking about our retirement saving in these two distinct phases. Your accumulation phase, as I say, which is where you are contributing, and your decumulation phase, which is where you are withdrawing. One of the good things about living in the Federation is that there are so many wonderful examples of centenarians, you know, people that have had really beautiful long lives. And if you imagine, you know, I read a study very recently that pointed to the fact that the average baby girl born today will live to be 100, and yet there is a huge income gap or pensions gap, certainly between men and women when it comes to saving for retirement on a global basis. And so it is imperative that we do what we can as early as we can to save for later life. And there are a number of different means through which you might fund your retirement. Your pension, of course, is one of them. I mean, your pension is effectively an investment. It's an investment in future you, and it will be composed of a number of different investment instruments, as I've mentioned, you know, fixed income, stock market investments. But there are alternative ways. You know, your pension should be viewed as just one part of your portfolio, your overall retirement portfolio. Some of us also have businesses, business income, and we want to get to a position where those businesses can run without our intervention and we're able to draw an income from them. And one of the most popular ones, which I know in the Federation is something that lots of people rely on, is rental income. And so I know that real estate is a particularly popular way to think about how you can draw an income, not just at the point of retirement, but certainly when you get to retirement, it can be a really nice booster to your overall retirement portfolio. The reason I outline some of these different options is purely to serve the point that actually there are options. So your pension is one that, you know, I'm going to get excited about because I love it. But there are so many different ways that you can save for your retirement. And so it's really just about keeping an open mind and identifying where those sources of income will come from. Wanting to have, you know, a comfortable retirement will require us to diversify our income streams, have multiple income streams if we're able to do that, but to start by having a plan as to what that might look like. So we've talked you know, already, Devon, about, you know, the correlation between money and mental health, and as it says here, you know, you control your money doesn't control you. I constantly have to remind people, you know, clients of mine, irrespective of their financial health, you know, there are lots of clients that I have who are in a position of financial abundance, but yet still feel hugely stressed about their finances, you know, perhaps because they have stepped outside the confines of what they can afford.
Okay.
There are situations in which lots of us can succumb to lifestyle creep. And for those of you that are unfamiliar with that term, lifestyle creep is effectively where, you slowly start, perhaps you've got a pay increase, or perhaps you are surrounded by people, you've moved to a new country, you've moved into a new work environment, you're watching people doing things and you're thinking, oh, that looks good, or maybe I should be doing that, and I want to keep up with the Joneses. And so suddenly you start to do things, that's lifestyle creep. And it's fine if you can afford it. It's also fine if that's part of your plan for your life.
Okay.
The biggest thing that I try to guard young people against in particular is this idea that they have to be seen to be doing a certain thing, and then it becomes more important to look like you have money than it is to actually have money. My priority is always to actually have money rather than, look
like
and have the appearances of having money. And I think it's particularly, in an era in which, social media prevails, we spend so much of our time online, and it's not just young people. I know lots of people my age who spend a lot of time on social media. And of course, one of the challenges of that is we are stepping into an artificial environment in which we have no real understanding of whether or not it's people's real lives. We think, people that are the same age, from the same background, if they are doing certain things, then why am I not doing those things too? I must be behind in life. I'm failing at life. So I now need to emulate what they appear to be doing. And I always encourage people to not just stay in your lane and stay focused, but actually to remind yourself, and Mr. Blake will talk about this when we come on to financial goals, what is it that you actually want to achieve? And be really disciplined, really focused, and be an exemplar in your group of friends and in your circle for saying, I know that that's what you want to do, and I'm going to cheerlead you and champion you in doing that, but I want to do something completely different because the plans that I have for my life look different. I think that's really important. So when we think about our mental health when it comes to money, we know that, poor financial health is a leading cause of anxiety, panic attacks, depression. And so one of the best ways to mitigate that is to have our plan in place, whether it's for your debt, whether it's for your savings, for your travel, whatever it is, and give ourselves grace. So we don't need to beat ourselves over the head with a big stick if we veer off course and have money mishaps. All of us, everyone in this room, in fact, I'm sure will have had a money mishap. Whether or not we want to reveal it is a different thing. But we will all have money mishaps. And so it's just about veering ourselves back on track if we steer off course.
Mm-hmm. All right, thank you so much. We're talking about adopting good financial behavior. And you piqued my interest when you spoke about will planning and how difficult it could be approaching, whether it be a family, extended family member, a loved one, about the topic of will planning. What advice would you give to people if they are contemplating having that conversation? Go ahead.
Yeah, great question. I think, and of course, there are different circumstances in different families, aren't there? I think, if you are having a conversation with someone that you already think might be sensitive to it, I would try to identify an ally or somebody that they know that has a listening ear, that will, that will be given a listening ear to by the person that you were speaking to. I think that's really important. So don't go in cold, don't go in alone. Try to get somebody along with you. It could be a sibling, right? Go with backup. It could be a sibling. It could be, I don't know, an aunt or uncle, but somebody that is trusted by the family. I think it's also important to maybe get some professional advice or guidance. Again, there's a lot of free resources out there that can enable you to just go in forearmed with this is information. It might be that, you plan a campaign over a period of months or weeks. It doesn't have to be a one and done conversation. It could be that you maybe pose the question and you say, I heard something about estate planning. Is that something you've considered? Have you already made provisions? You might share an anecdote about the chaos that's ensued somewhere else, either real or imagined. Ultimately you're trying to open up a conversation. But again, we all will know those circumstances in which people have suffered, and we know that the people that love us in our families don't want us to suffer needlessly and to suffer twice through bereavement. And so I think it's important that we gather all of the information that we can together, get an ally and get a professional.
Achieve those goals within that period of time. Now, not everything goes according to plan. Things can happen. Things get in the way. We had the COVID pandemic. Some people lost their jobs. So some of the goals they might have set at that time, they have to go back and say, well, you know, because I lost my job, I could not have met that goal in that period of time. So it's important as well, during the period, you continually assess where you are in relation to the goals that you've set. And sometimes you have to go back and recalibrate and adjust your goals based on the objective circumstances at the particular point in time. So that is important as well. And if you want to achieve anything, it's important that you set smart goals. Many of us might, through happenstance and good luck, achieve things, but most of us have to set some targets and work towards achieving those targets over time. In terms of good credit, and some people might wonder, why is it important? And if you happen to be looking at the TV and see the slides, you'll see a guy on his knees proposing to his girlfriend. And she said, no, not until you improve your credit. So it's important that we have good credit. But good credit is important to enable you to access credit. If you need a loan, you go to a bank, your credit union, whatever. They are going to check with the other banks. They're going to do a credit check to find out, is this person a good risk?
Right.
So if you do not have good credit, you may find yourself being unable to access loans and other forms of credit. One of the important things as well is banks tend to price their loans based on the risk. If you have good credit, you're seen as good risk, you might get a lower rate of interest. You might get better terms for the loans. Even if the interest rate is the same as for other persons, you may have better terms for your loans because of your good credit standing. It may also reduce the need for collateral. If you are not such a good risk because you've had a number of bad debts with other institutions, a bank, even if they want to lend you, or a credit union for that matter, may say, in order for us to lend you, you need to put a certain amount in place in terms of collateral to securitize that loan. If your credit is good, the need for collateral may be reduced.
Okay.
As someone with good credit also have more options for getting loans, etc. They're able to shop around to see what is available, and other financial institutions would be interested in getting their business, so they might be even targeting them. So instead of you having to go to the financial institution, the financial institution may be coming to you to offer you credit so that you're able to get what you want. And not many of us have the disposable income that we need to acquire assets, especially the bigger ticket items, a car, a house, and things like that. So you need credit in order to acquire these things. And in order to build wealth, in order to create wealth, you have sometimes to borrow and put those funds to work for you, to invest those funds in some asset that will over time create benefit to you. So it's important to have good credit, so you could progress towards wealth creation. So how do we create wealth? Firstly, one has to earn. So you have to get a job, start a business, whatever, something to earn your money. That's the first step. You would not be able to create wealth unless you have something to work with. You must have something in order to work with to create that wealth. You cannot create wealth out of anything. You need money, you need ideas, you need, so if you don't have a job that is paying you sufficient money so that you have disposable income to invest, you have to find something, start a business, find some product, something that you're good at that you could sell to others to earn money in order to start building wealth. And then after earning, the next step you have to do is to retain some of what you earn. Davina went at length about the importance of budgeting and all that, so I wouldn't cover that again, but it is important that you put aside, and she used the 50-30-20 rule. What I would say is at least 10%, whatever you earn, at least 10% you should try to retain. So no matter what your circumstances, no matter what your income level is, try to retain at least 10% of that as a starter. The more you are able to retain, the better it is, and the quicker you're able to create wealth. But if you start out from 10% from the word go, I think you're in a good standard. You're in good stead, sorry. And what you should be seeking to do is to try to increase that proportion of your income that you're retaining, so that you could have sufficient to save and then to invest to create wealth. Now, after retaining those funds, the next thing is to do is to save. And as Davina said, you have to put aside your emergency fund, save for the rainy day. There are going to be times when you need to call on that emergency fund to deal with some big ticket items, whether it be a health matter or what have you. So savings is important for that. But savings is not enough. As I frequently say, I don't know anybody who saved themselves rich. I mean, there may be some out there, but I just don't know them. So if there are some, you know them, great. But savings alone will not do it. It's important to save, because you have to have that nest egg to deal with the emergencies, deal with the rainy days, etc.
Correct.
But you have to save and build that savings to a level that you could then take some of that savings to invest, because that is how you're going to create wealth. You're going to create wealth by investing. So the next step is, after savings, is to invest. And there are a plethora of things you could invest in, and we're going to talk about some of them in a minute. So savings, that enable you to multiply the assets that you have, the money that you have, so that you're able to create wealth. And what we want to be able to do is to create wealth, generational wealth, because that's not something within our circles that we tend to talk about a lot. We want perhaps to get a lot of money so that we could buy a nice car, build a big house, and things like that. But let's think about creating wealth for generational purposes, so that it will go down through generations, and that your future generations are able to start life a little more comfortably than you did, and are able to build on what you have created, and create even more wealth into the future. So what then we could do in terms of investing and the investment options that are available to you? From the very basic, in terms of generating income, we have CDs, or fixed deposits, with banks and other financial institutions. Those are good. They give you a better interest than savings for the most part. So that's something that you should start to branch out into almost immediately after having built up your nest egg. The benefit of CDs as well, they are relatively liquid in that they're pretty much short term, maybe a year or so. So within a year you have your principal that you're able to either reinvest or use for anything else. And the possibilities are, depending on circumstances, you may have to break a CD. You would pay a penalty in terms of the interest that will be lost. But if you really do need the money, that's an option that you could break your CD and use it for whatever the necessity may be. Another thing you could do, you could borrow against those CDs, and if you don't want to lose the interest, you could borrow. But what I would advise you to look at, the differential between the rate you earn on the CD and the rate you're going to pay on the loan. Makes no sense to me personally be paying more than you're earning.
Okay.
So, but it's important as well that you do have some savings, a nest egg. So you have some liquidity, some cash that you can deal with any emergencies. The next thing is bonds. Again, bonds, pretty good, give you a fixed rate of interest, and you will get that regularly over the period of the bond, whether every half year or some bonds pay quarterly, as the case may be. And it's relatively safe. You wouldn't lose the principal unless the issue of the bonds go bust. And most of the bonds that we have around here are government bonds, and it's quite unlikely that governments will go bust. Although we know some governments refinance from time to time. But bonds are pretty safe investments that you could make and get a rate of interest that could give you some income over time. But there's nothing exciting about that. I mean, again, you're not going to get rich from it. You'll be able to preserve your wealth, but you're not going to get rich from it. The next category is investment funds, and typically mutual funds. And we have some coming into our region now in recent times. Again, these are instruments where one is able to pool your investment with other investors or other holders of these funds, and those funds could then be invested professionally on your behalf by the fund managers. Again, that gives you an even better return on average. It's depending on what the fund managers invest these monies in, the risk could be relatively low. Presumably, they are professionally managed, so that these managers have the skill to avoid much of the sort of very volatile instruments, so that you wouldn't have too much risk of capital loss. But again, not terribly exciting. You'll get a return. It's going to be above what you'll get on the other forms of investment. But again, it's not gonna get you rich, so to speak. It's gonna help you to build wealth, but it's not gonna be super. You're not gonna get any super returns from a mutual fund. So we go to the next category, which is equities, and these are shares in companies that are listed on an exchange. This is where I think there's great potential for capital gains and growing your investment. So I strongly recommend the investment in equities to those persons who are about creating wealth. The return on the investment in equities is twofold. There is the dividend, which is an income stream that you get on the equities. As the company makes profits, it declares a dividend and pays a dividend on its shares over time, and that again is good income. Those returns tend to be relatively high. And there's a second part, which is the capital appreciation, the capital gains that you get as the company grows. The company is profitable, its value increases, so the value of your investment in that company increases over time, and that capital gains could be significant, and that is what I think would generate significant returns for investors on the investment in equities. I think one is able to create wealth through investment in equities. Then there's also real estate. I think real estate provides a significant potential as well for persons to create wealth. The value of property increases significantly, and especially in our countries where land is relatively scarce. and concentrated in government hands, etc. So the return on property investment tends to be high. You've known many people who have created wealth from property investment, either buying property, upgrading the property, building equity in that property, and selling at a later point and generating significant wealth. The question about renting or buying came up earlier in the conversation, and I would strongly encourage everybody to try to acquire a property, at least one property. Over time, you build equity in that property, and that property is a significant part of most householders' wealth. Most householders, a significant part of their wealth is tied up in the property as they build equity over time. I mean, we know of the prices of lands in St. Kitts and how it has increased over time. I remember when land in Frigate Bay was selling for $2 or $2.60 a square foot. Today, people are asking $20 US dollars per square foot. There's not many other asset classes that could give you that level of return. And you have to live somewhere. So if you're going to live somewhere, it's better you own and benefit from the equity that you accrues within that property than to leave it for a landlord to earn. So equity property investment is one that I would do. But if we look at the investment options on the ECSE, I'm not going to say anything else about real estate. I'm going to speak complete about financial assets now. On the ECSE, we have something like 174 securities listed. And if you are able to see my chart, you would see that includes some 14 equities, 14 companies that are listed on the exchange. 13 or 14 treasury bill instruments, and 12 treasury notes, and 160 debt securities, government debt securities. If we move to the next slide, we'll talk a bit about the equities that are listed. We have the 14 equities, as I said, listed on the exchange, spread across some 6 sectors. We have utilities, we have energy, we have property companies, we have trading companies, and we have financial institutions. So in that 14 companies, we have it spread across some six sectors, which provide significant diversification possibilities for any investor who wants to invest in equities. I think that's one of the strengths of our market. While the numbers of companies are maybe small, the diversity that exists is phenomenal. There's also diversity across the geographic space. Our market is a market of the 8 member states of the Eastern Caribbean Currency Union, and we have companies listed from 6 of the 8 companies on the ECSE. So again, you have a spread. You have a company in Antigua, in Dominica, in Grenada, in St. Lucia, here in St. Kitts Nevis, in St. Vincent and the Grenadines. So again, you have a geographic spread that gives you a degree of diversification that is critical in terms of building an investment portfolio. And diversity is important, diversification is important to reduce risk. Again, the equities that we have listed provide significant opportunity for you to create wealth while spreading your risk across sectors and across geographic areas. And then we have the listed debt securities. As I said, these are important in preserving your wealth. We have a number of debt securities, and trying to read my slide from the distance, but we have we have not only EC dollar denominated debt instruments listed, but we have US dollar denominated debt instruments listed. So of the 134 bonds that we have listed, 101 EC dollar denominated bonds and 23 are US dollar denominated. And the treasury notes, we have one of the 13 that is a US dollar instrument. So again, if you want to spread your risk across currencies, there's something for you on the ECSE to enable you to do that. And then the debt securities are also spread across geographic space. We have debt instruments listed in Antigua and Barbuda, in St. Lucia, in Grenada, in St. Vincent and the Grenadines, St. Kitts and Nevis, and Dominica. So again, we have a tremendous spread of instruments that enables an investor to find something that meets their needs on the market, or to construct a portfolio that suits their particular circumstances. I invite you to visit our website, www.ecseonline.com, where all this information is available. If you click on any of those buttons at the top, you could drill down to get the information that you want in terms of investing to create wealth for yourself on the market. I will also encourage you to visit one of our member broker dealers. We have 6 across the currency union. Here in St. Kitts and Nevis, we have the Bank of Nevis and the St. Kitts and Nevis Anguilla National Bank. We also have the Bank of St. Lucia, the Bank of St. Vincent and Grenadines, First Citizens Investment Services, and the Grenada Cooperative Bank. And at these brokerage houses, we have representatives who are trained and licensed to provide investment advice. I encourage you to visit one of these brokers and find out how you could go about creating wealth on the ECSE. Thank you.
Thank you so much, Trevor. For those of you who are just tuning in, you're listening to the listening and viewing the FIM Festival 2023 live discussion. I'm your moderator, Devon Cornelius, and joining me on the panel this evening is Ms. Davinia Tomlinson, an award-winning author and entrepreneur, as well as Mr. Trevor Blake, Managing Director. Mr. Blake, I had a few questions that came in via social media, and I had questions of my own. You spoke about the importance of maintaining or having good credit. Let's say you have somebody who is currently not in that category, so they're heavily indebted, they have terrible credit. Is there such a thing of getting from bad credit back to good credit?
Absolutely.
Okay.
Absolutely. First thing you have to do is to take stock of your financial affairs.
Okay.
What do I owe? Who do I owe it to? And what we find is you have some persons, they have a higher purchase from maybe 2 of the stores in town. They have a payday loan from one of these operators. Mm-hmm. They may have a car loan from one of the banks, and maybe it's a loan for vacation from another bank. Mm-hmm. Look at all of that and talk to your bank about consolidating that into one facility that you're able to service. So do an assessment and see what the debt you have, the income that you have available for debt servicing, and try to get one of the institutions to refinance the entire thing so that you pay one payment to clear that debt over time. It's gonna take time, but it could very well be done. The other thing that lots of persons run up is the credit card debt, and that's the most expensive type of debt. So that's the first one you should seek to repay. So you want to be able to get a term loan in order to refinance that credit card bill, pay out that credit card bill, and because the interest rate on that credit card bill is up close to 20%, if not more. For example, I try to pay my credit card bill in full at the end of the month, so I don't pay interest on it. And because no use to me for having savings account earning 2% and I'm paying 20% on a credit card. That makes no sense to me. So try to pay off your credit card every month, and that helps in building your credit as well, and improving your credit score. But anybody who has bad credit, sit down with a financial advisor, sit down with a bank, the credit union, and try to work out a facility that would consolidate all of the debts that you have, so that you pay one installment every month towards clearing that debt. And if you do that, and you do that religiously, you will improve your credit score. The other thing is, I should say to persons out there, ensure that if you have a loan and it is due on the 10th of the month, pay it by the 10th of the month. It does two things. One, it shows that you have the discipline to make the payment. And secondly, you save money, because every day it's late, you're going to get a late fee, and you're going to get more interest accruing on the interest that you have. So you need to pay your loans as they're due. Pay your utilities as they're due. Lenders are now looking at all institutions to try to determine whether or not you are a good risk. So they look at everything, whether it be the Horses, TDC, courts, whoever else are giving hire purchase out there. The banks look to them for information on the persons who have outstanding facilities with them and how well they're servicing them, or if they're not servicing them. So it's important that you pay, you meet your obligations when they fall due.
How does one get around the issue of not being able to build good credit because of their age and job, where banks won't give them a loan?
Yes, age is definitely a factor. If you're up in age, the banks may be a little reluctant to give you a loan for any long period of time. And this is why, as Davina said, you have to start early, establishing good financial habits, good money habits, saving, investing, and ensuring that you are able to put aside some of your earnings so that you're not stretched in your later years. She had a very instructive graph that showed the years of of accrual and the years of consumption. Those are my words. Yeah. So it's a continuum, and when you get to the age like me, you're getting down. So you should have already sorted out your financial affairs. You should not be in a position that you're looking for credit to refinance debt. But with the best will in the world, sometimes things happen that causes. Again, you talk to your friendly credit union, talk to your friendly banker, and see what could be arranged within those limited circumstances. What you should not do is to go to, and I'm going to make a few enemies, but to go to those persons who are coming with the quick payday or whatever they loans. Bad news. Try to stay away from them. Stick with your credit unions, your banks, the regulated finance companies, and try to work with them rather than the other sort of facilities out there which are unregulated, and really the rates of interest that they charge. It might sound like a good thing. All you have to go in and show that you have a paycheck coming in. But trust me, it is the worst thing that you could possibly do. If you remember nothing else, that I say, stay away from them.
Thank you so much for that advice, Mr. Blake. What percentage of your yearly income should be in your savings account in order to carry you over in case of an emergency?
A rule of thumb, I would say it's three to minimum 3 months income, salary. So if you earn $100 a month, you have at least $300. 6 is, more like it. If you have 6 months to guide you through, would be best, but at least 3 months salary in savings to guide you. Because things, like we had COVID, for example, persons lost their jobs. So, even outside of that, you could, the business that you work for, could be, retrenching. You may lose your job for whatever reason. So you need to have something to keep so that you could depend on during the period when you until you search for a new job. You could be ill and unable to work, or things like that. Especially if you're self-employed, you probably need a little more than what you would need if you have in a salary job. So at least 3 months, I would say.
Another question coming from social media. I've heard that buying a car or a used car is always better than buying a new car, because once driven off the lot, a new car depreciates by about 10%. What's your take on that?
Yeah, it just depends on your circumstances.
Okay.
Yeah, the question is right. Driving, they said 10%. I would say even more. If you drive your car off the lot at TDC or Horsewoods or Keynes or whichever dealer, you cannot sell it for what you've just paid for it. Once you drive off the premises, there's no way you're going to be able to get what you just paid for it once you've driven it away. Just one of those things about it. People, and look at it. Look, I mean, it's logical. If you have to buy a new car, and somebody already drove it, and the very same model is sitting in the showroom, new and nobody's ever touched it, which one would you go for? Yeah, but a car is a depreciating asset, and in the first year, it's the highest level of depreciation. The hardest car to sell is a car that is under 1 year old. It's the hardest car to sell.
Oh.
Because the price you would want for it would be close to what you've just paid for it less than a year ago. But nobody's going to pay that, or very few people will pay that, knowing they could walk into the showroom and get one brand new.
So it's highly unlikely that you could make a solid profit off of selling a vehicle.
Not new, not a new vehicle.
Okay, new vehicle.
Not a new vehicle. So in that regard, I mean, buying a second-hand one, and if you buy a second one, you care it and you fix it up nicely, and it looks good. Somebody might pay you more than even what you paid for it, but you certainly would not get more for what you paid for a new car, or even close to the price you paid for the new car once it is below a certain age.
And lastly, why is it that the investment rate for residents and citizens of the ECCU is low compared to that of the United States?
Very good question. Investing is something that is relatively new for us as a people, and this is across the Caribbean. Whereas in the US, it is something. I mean, we have securities markets in the US going back hundreds of years, so it's a habit. The other thing is that we actually are not taught to invest. I mean, we get into investment by the way. Whereas in schools in the US and other places, where the questioner spoke about the US, in school the kids are taught financial education. They have financial education in the grade 11, grade 12 in the high schools. Then there's the whole retirement industry in the US is based on investment. So your 401ks, etc., are based on investment. Here, it's your social security and your pension funds from your companies, etc. So those are things that lead to the involvement in securities markets or stock markets, as opposed to what we find here in St. Kitts. And it's very new to us. I mean, we've only had a market, securities market, since 2001. The US, as I said, it goes back centuries. The other thing is that they're the brokers, the mutual funds, etc. The Charles Schwab's, the Fidelity investments, those that market very heavily, and there are brokers out there selling actively in the US, and that doesn't happen here in the same way. We have broker dealers, yes, but sometimes they're not as aggressive as they could possibly be to get people into investing.
Mr. Blake, thank you so much for that, and we are actually out of time. It's about close to 9:30, and so I'm giving you the opportunity now to give your closing comments.
Right.
Go ahead. Yes.
Okay. Yeah. One of the things that I think we need to start, and especially amongst the younger generation, because they're the ones who are on the climbing stage rather than the downwards.
Okay.
Is to get involved in investing, to start to invest, to see investing as not something foreign and not something for wealthy people, but for anybody. Anybody could get involved in investing. At whatever stage you're at, how much ever you have, whatever you have to invest, go to one of the broker dealers, talk to them, see what the possibilities are, and start investing. As I said, the only two ways you're gonna really build wealth, unless you win the lottery, or unless you come into a big inheritance, is by investing. And investing in financial assets is one of the best ways of building that wealth. You have a regulated market. You have very disciplined players in the market, the broker dealers, etc. They're all well-known, established financial institutions. The people are well-trained and are licensed to give investment advice. I suggest you visit one of the broker dealers and start to talk to them about getting started in investing and creating wealth for yourselves.
Thank you so much. Davinia?
Yeah, I mean, I would echo what Mr. Blake has just shared, but I think one thing that I would like to add in addition to that is that, as children form their earliest money habits by the age of 7, which I think is a statistic that is not very well known. So there are lots of habits, when we consider our relationship with money today, there are lots of habits and behaviours that we might have as adults that unless we do some self-interrogation, some self-inquiry, we will have no understanding that we're carrying through both positive and negative habits and behaviours that are impacting and influencing how we manage our money. So I think that is a really good start point for any of us. But as Mr. Blake alluded to in his presentation as well, I think we all need to have some clarity. We all need to have a financial roadmap, or at least some idea of what the destination is, what is the end point, and what are the milestones in place to help us achieve that. So again, if you can all individually think about your personal finance hierarchy, start where you are with what you have, and as Mr. Blake said, ultimately have the objective in mind to invest in assets, but recognizing that we are each of us our biggest investment and asset by far, and so we should feel good about everything that we do every day to develop ourselves, because that knowledge and education is what will enable us to invest in the markets, to thrive in our careers, and ultimately build wealth over the long term.
Thank you so much, Davinia. You've been listening to the Financial Information Month FIM Festival 2023 live discussion. I've been your moderator, Devon Cornelius, and on the program this evening was Miss Davinia Tomlinson, an award-winning author and entrepreneur, as well as Mr. Trevor Blake, a managing director. Guys, thank you so much for being on the panel this evening. It was a very fruitful and engaging conversation. Until next time, and I say next time because I know we're going to come back. You guys are probably going to join me in a different setting, and we're going to continue this conversation. But until next time, you guys stay safe. Thank you.
It's Financial Information Month in the Eastern Caribbean Currency Union. Financial empowerment through education. If you don't know what that is, let me tell you all about it. Learn to spend wisely. FIM. Invest to grow your money. FIM. Business stability. FIM. Step up financially. FIM. Help build the region's economy. Work to financial security. Prosperity for all of we. FIM is for you and me. FIM is for everybody. So tell your friends and your whole family. Financial empowerment through education. Build yourself and the entire region. Learn to spend wisely. FIM. Invest to grow your money. FIM. Business stability. FIM. Step up financially. FIM. Financial Information Month. Financial empowerment through education.